market overvalued? Is the price earnings ratio telling that, or is the price to book ratio of the market telling that, or more interestingly, is the market cap to GDP ratio of India telling you that the market is overvalued? Right? MCAP to GDP ratio, often called as the Buffett indicator, because the great Warren Buffett has used it uh, in some context to understand whether valuation is very high. So it's actually called as a Buffett indicator. Is this indicator a right indicator, or can you use it to interpret the textbook meaning in the context of several economies and markets? In other words, does this ratio behave alike in various economies and markets? So let's understand, how this ratio can vary in different economies and how to use it in the context of India. So in this presentation, I'm going to have a lot of text here as well, because I'll be throwing in a lot of numbers. So it's easier for you, to grasp it when it is there on the slides. So you will see quite a bit of text, right? Let's just first understand why we are looking at GDP of a nation to gauge the market, right? End of the day, the domestic product or the value addition made in the economy should ideally be reflecting in the market, assuming that a majority of the companies are listed. In the case of India, although a majority are not listed, the very large ones are listed. So looking at a nation's GDP growth and the market the market size, the market cap, you will see that they are actually somewhat correlated. That is why typically this is being used to correlate whether a market has grown as much as the GDP or lower than the GDP and so on. In most developed economies, obviously many companies, many large ones will be listed, so it makes a lot of sense to look at it in the context of India. Although we do have a large number of companies that are unlisted, still they are all small. Smaller companies are unlisted, so a majority of the large ones will reasonably represent what's happening in the economy. So first thing is that yes, they are correlated, and it does make some sense to relate the two of them. Now, why do you look at them? You look at them because it gives you a good sense of the growth opportunity in the economy and therefore in the market as well. And what does textbooks say when you do this market cap divided by GDP? Basically, it says if your market cap is greater than the GDP itself, it means that your market is overvalued. That is, it's over 100% or over 1, whichever way, as a percentage or as a ratio if you take. And the reverse is true, that it is lower than 1. There is still some upside in the market, or that it is undervalued. This is the textbook definition. Now we are going to go ahead and see how this has transpired or behaved in various markets. Now I'm going to actually take a lot of data from an article that my colleague Chandra Chudamani has written on this subject. I am simply presenting it. Much of the legwork in terms of the collecting the data and presenting has been done by my colleague. Now just let's look first at the MCAP to GDP ratio of some of the key countries. Needless to say, you will see that the US has 1.76, which means its market cap is 1.76 times its GDP. Japan is actually quite high at 1.38. Canada, again, one of the more developed nations, quite high. France, very interestingly, in the Eurozone, you will see that more than Germany, which is the most industrialized nation in that region, or United Kingdom, which does a lot of trade, France actually enjoys a higher GDP, market cap to GDP ratio. Right? India, this can, you know, uh, this had crossed one before March, 23, but it came down after some correction that we had at 0.97. It's a moving number, so it could cross one also, or could have already crossed one, because I'm taking the earlier GDP. There is a lag in the GDP. Now, just put a pin on this. Observe what are the numbers. The high ones, United States, Japan, and in the Eurozone, Germany. So let's, take those and understand If these are high, does it mean that these markets have not delivered at all? They are overvalued, they should have crashed, but they have delivered. What's really happening? Which means you can't take the textbook definition that a high MCAP to GDP means, overvalued and there is a correction, right? Now let's take the case of US and China. We saw US, why have we taken US and China? US is the largest economy and China is the second largest, and yet there is a significant difference in their, market cap GDP. While one is headed towards almost 2, the other is under 1 at about 0.7, right? The size, look at the size of the economy, $25 trillion and China $18 trillion. It's not like way away, right? And what you need to know is that historically, even US has traded at an MCAP to GDP ratio of less than 1, that is less than 100%, until the 2001 dot-com bubble, when the market went way ahead of the GDP. But after that, after correction, etc., this ratio has consistently been moving up. And how has it been moving up? It has been moving up with the rise of tech companies. When I say tech, you do know what I mean by tech. In those days, there was IBM and Microsoft and so on. And then came your Google and your Facebook and all your FANG stocks, right? So before the 2009 crisis, the US index basically had oil and financial majors, and that was predominantly when it was actually trading below 1. And once this technology revolution started in the 2000s, you started having companies, uh, with valuation of 300 and 400 billion dollars as opposed to 100 billion dollar companies, right? And that's how, the birth of multiple trillion-dollar companies came in the US. Just to put that in context, US has over 10 companies with over $500 billion in market cap. And if you just take the above $100 billion market cap, it's 75 companies. Now let's look at China. China has no companies with over $500 billion market cap, and it has just about 14 companies with market cap of over 100 billion, right? Obviously, some companies could have grown, but they had some crackdown by the government, and they did in China. So that's a different story. And out of these 14 companies, actually, if you see those with $100 billion and above in China, most of them are obviously public sector enterprises and operating in very traditional sectors like energy, telecom, financials, construction, insurance, and so on, right? As opposed to the US, where there has been a significant technology rise. So all these 300, $400 billion companies we're talking of are all majority in the technology space. So what are we trying to say? So look at the growth in market cap in US being driven by high growth rising sectors, as opposed to China, although with a large economy, did not see a proportionate increase in its market cap or the size of its companies in the market, in the stock market, right? What happened was a majority of these companies were public enterprises. There wasn't competitive capitalism happening in China. There was a lack of local brands. Local brands never made it very big in terms of being global, like US brands did. They have been, but it's not in the scale of US brands. And needless to say, restrictive government policies. So all of this, basically ensured that this gap between market cap and the GDP existed. Right. So in GDP, companies were, the Chinese government was building roads, building huge infrastructure and all that, but the growth in terms of the market cap did not happen. Therefore, sometimes even large investors who believed in the China's economic growth and plowed their money have been questioning themselves in terms of whether they're getting the right stock market returns. So what is the lesson here? When something is given higher value, there is a reason for that higher value, right? We will sum up what those reasons are in a later stage. Now let's get into another example, which is in the Eurozone, which is, Germany. Germany, of course, as you know, to Germany and also France, I'm sorry, there's a typo there, are among the two major industrial nations in the Eurozone. But you will see, and Germany has always led all major technology, the industrial technology and all that, right? But you will see that in the case of this Buffett indicator or MCAP to GDP, Germany has a lower MCAP to GDP compared with France's, which is 1.1. Why is this the case, right? If you once again go back and see the MCAP to GDP, you will find that Germany has just three companies about $100 billion, whereas France has about six companies. Uh, Germany's largest in terms of MCAP is $150 billion, and France is more twice that or more at $380 billion. You know the common names of SAP, Siemens, Porsche, Merck, BMW, all of these top German companies, are top-notch companies. I mean, Germany is really known to be an industrial nation. In France, it's actually more consumer-oriented, although France has had names like Legrand or Renault or Alstom and all that coming from a very hardcore manufacturing and industries, but the names that have built market cap value in France are LVMH, L'Oreal, Hermes, Dior, Essilor, and all of these, right? So you see the difference here in the sense that the German, there are many of these German industrial and auto giants, and on the other side, there's this French beauty and fashion major. Both of these brands made significant global presence, right? Unlike in China, where I said in the US China case, US made more global presence than China, but in this case, both made significant global presence. But the French companies ended creating more shareholder value, right? The auto majors or the industrial majors in Germany have been less profitable. And I say profitable in terms of margin and less value accretive. In fact, the entire auto industry, barring perhaps Toyota, did not really build value accretive returns for its shareholders. So that's the difference. Here we have two big companies, one having MCAP to GDP of more than one, the other having less than one. And this has been given for a reason, because the one with higher, more than one, France, actually has built higher ROE companies, higher value accretive companies compared with the companies in Germany. So here again, this 1.1 is not an indicator of higher valuation, but indicator of the kind of returns and efficient returns that the companies have generated in that French market. So this is the, kind of a summary. The first summary, which I gave, again, high valuation in US versus equally large, in China, why one country enjoyed higher valuation than the other. Here again, same story, but for different reason. Whichever market generated higher ROE got higher, valuation. I'm going to take one more example before summing this up. Japan, right? We all know Japan has remained kind of stagnant after it grew rapidly between 1980 and 95. It started having problems after the Nikkei bubble. They call it the asset bubble. And, at that time, almost 45% of global market capitalization came from Japan. Imagine how large a size Japan would have been. But economic growth has averaged between 0 to 2% for almost 3 decades now, which means almost a stagnant economy. But when I showed you the MCAP to GDP, you saw that Japan enjoyed 1.14 MCAP to GDP, right? The stock market had bottomed out between 2009 and 12 after almost 2 decades of decline, but it is now going back to its older 1989 highs, right? In fact, some of Warren Buffett's own investments in Japanese conglomerates is testament to the fact that something may be happening in this economy. How is it that this economy isn't growing and the market cap has grown to more than one time its GDP? So let's try to understand that. Although Japanese own internal consumption was anemic, that's why its GDP didn't grow much. It has been earning a lot through exports. They export over 900 billion worth of goods annually now. And needless to say, they're all high-end, products, right, from automobiles to electronics to automation and all of this. And they do have companies with over 100, billion dollars, and a large number of companies, a good number of companies with over 50 billion. The Spanish in fashion retail Uniqlo is all the sixth position with a market cap of 73 billion. All of these, these are very, very popular brands that are there across the globe. This would not have been possible like this market cap would not have been possible if Japan had simply grown internally with depending only on its domestic growth, because its domestic growth was very anemic. So the significant exports of high value goods, high end value goods, has ensured that this company could still score in terms of market cap. I mean, take Toyota, it's probably only the most valued company after Tesla, although the entire industry is struggling to give sufficient returns to shareholders. So this is a case, basically, the ability of private sector enterprises to grow outside their own market to ensure that they survive and grow in spite of an anemic GDP growth, right? And it's interesting to note that Japan's market cap is twice as much that of Germany, right? And both economies of the similar size. So you understand where Japan's growth came from, right? And so it got a premium despite a slowing economy, right? So all these three instances, basically, I have said are cases where you cannot make a judgment on the valuation of market based on the fact that it is greater than one, which is the textbook definition, right? So when the market affords something greater than one, it's possible that there is a reason for doing so. And let's understand the reason. The first one, like I said, is efficient private enterprises that delivered higher return on capital, resulting in higher stock market valuation. This happened in the case of France versus Germany. The French companies, the fashion brands, all that I spoke of, delivered significant return on equity to investors as opposed to the industrial and manufacturing firms in Germany. The second thing that I said, is true of Japan. Ability to grow beyond your home country, and that too profitably, will give you a relatively higher premium in the stock market, right? That's a very classic case. That's the classic strategy that Japanese companies adopted. The third, China could not get such valuations because the policies were not really in favor of competitive capitalism, whereas in US it was entirely focused on high capitalism and innovation and invention, and that led to enhancement of the stock market valuation. So these three are very classic examples. Let's try and apply them to India now. Right? India, interestingly, you did see that India was at close to about 0.97. There have been periods when it crossed one, even in 2023, early 2023. It has always enjoyed a healthy market cap to GDP ratio for the simple reason that we do have high quality companies represented in our index. We have financials, unlike certain other countries where financials don't give ROE. Fortunately, after all the balance sheet cleanup, etc., Indian financials continue to give high ROE. Besides that, we have a very healthy representation of IT companies and consumer majors. Imagine these three. These three literally capture all that you want. I mean, your private sector financials really capture the domestic growth quite well, right? They kind of, the credit growth that's happening here is a reflection of the domestic growth of, the country, whether it is borrowing to build in the case of companies or it's borrowing to enhance quality of life in the case of individuals, right? IT services, if you take IT services, very interestingly, has ensured that we go beyond our shores. We get a large chunk of our export revenues from IT companies. So we have gone beyond our shores. So there is a fine mix of domestic revenue that you get from these financials and the export revenue that you get from IT. This has also ensured that we have a good balance, unlike some of the other countries that I discussed. And obviously, there are consumer majors that are more resilient, that can continue to show growth even when the cyclical ones like financials slow down, right? So we have a very good mix. And that is one of the reasons why our market cap to GDP ratio has always remained healthy. So it's not going to, if you're going to wait for a depressed market cap to GDP, that may be a very, very rare event to happen. That's something that you should be aware of. And also the number of companies with the ability to generate business outside of home market has significantly grown. Many of our Indian companies have acquired companies abroad, right? And companies have changed colors. If you take Reliance or L&T, the real value addition happened when they started diversifying beyond their what they started out as core businesses. Petrochem for Reliance is now well and beyond. They are into, consumer discretionary. They are into, telecom. They're into a lot of things. Similarly with L&T, right? From just being an infrastructure company to being an high-end engineering company, there has been a lot of transition, right? So this is, and you can actually apply this to even companies themselves to understand this. If you take the Tata Group had Tata Motors. Tata Motors even today has higher revenue than its top company, which is Tata Consultancy Services, right? But where is the higher value? It comes from TCS and not from Tata Motors. If the Tata Group had not developed TCS, probably the group's worth itself will not be very high today, right? This is exactly what has transpired at a global level also. Those countries that have diversified, moved beyond home turf, or have had very competitive capitalism, have all continued to enjoy higher valuation. So when you look at the MCAP to GDP ratio, it's very important to understand this context and then, kind of assess whether a market is overvalued or undervalued. In other words, simply looking at the number can be very deceptive. It might force you to exit too early from a market that is growing and thriving. If you like this video, do subscribe and also do check our website for more interesting articles and also even our take on, whether the markets are overvalued or undervalued, what sort of stocks you should be playing and all of those. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.